Hello and welcome to News in Depth with TVP World. I'm your host, Maciej Wilowski. 2025 was an eventful year for the global economy, with U.S. tariffs, geopolitical fragmentation, and AI dominating the headlines. Joining us today to break down what happened this year and what to expect heading into 2026 is Magdalena Polan, head of emerging market macro research at PGIM Fixed Income. Magdalena, pleasure to have you here. Welcome.
Thank you. Glad to be back.
So Magdalena, we see that despite all the uncertainty happening in the global economy these days, emerging markets and stocks more broadly around the world have really outperformed this year. What do you think accounts for that outperformance despite all the uncertainty?
Yes, this was a very eventful year, and lots of things happened. Sometimes things happen in the decades, and I think this year a lot of them happened. There was a lot of concern, obviously, with the new U.S. president, with a very different political agenda, and the very strong shift in the U.S. economic policy. There was a lot of concern going into both February and then April tariff announcements that the global economy, and especially emerging markets, may suffer from that shift in policy. But as we saw, the global economy, China, but also all the other emerging markets, proved to be very resilient to these risks. And neither growth, nor inflation, nor global trade actually suffered. And that fueled that strong performance in the markets. The U.S. equity market performed really well. Already the year before, also performed quite all right this year, also because of the AI buildup. But the combination of inflows, strong growth, weakness of the dollar, strength of the emerging market currencies, inflows into the local bond markets created that positive set of catalysts that led to the outperformance of emerging markets.
Now, as you had mentioned, global trade and in particular U.S. tariffs were perhaps the dominant economic story this year in 2025. How has that reshaped global trade flows and global commerce so far?
That's a very good question, because when we look at where trade goes and who trades with whom, we see that emerging markets trade, so from one emerging market to another emerging market, is really one of the dominant trade flows in the global economy. And global trade increased quite a lot this year, driven predominantly by China and emerging markets. So tariffs were not that important. We've seen some build-up ahead of the tariffs, because the U.S. purchased goods ahead of the announcements, and then a little bit of a correction. But otherwise, flows continued. But what we have seen so far, and that change is ongoing, is that following this announcement, countries outside of the U.S., say China, European Union, Mercosur, but also countries in Africa and Asia, have started to trade more with each other and are also actively pursuing trade agreements that will allow for more trade, which would shift that trade even more towards these countries.
Now, China, as you had mentioned, has experienced quite a boom in industrial production and exports this year. And that's in many ways contradictory, because U.S. President Donald Trump, when it came to implementing these tariffs, had promised a manufacturing boom in the U.S. But we see, looking at the data, that has not occurred. And if anything, it's China that is experiencing more of an industrial boom. Now, with the rise in exports from China to Europe, particularly with items like electric vehicles, does this pose a threat to European competitiveness?
That's a very good question. So let's start with the first part of that, the strong growth in China. China remains still a very manufacturing-based economy, despite efforts of the leadership to shift it more towards consumer-driven economy. But consumption is not recovering as long as consumer sentiment, real estate market remains subdued. So the only way really to fuel Chinese growth and push towards that 5% target is export. In the US, which has shifted a lot towards services, it's going to take a little bit of time to actually rebuild the manufacturing base. So it's going to take time. And yes, China is exporting a lot to fuel the economy, and it's exporting both to Europe, and as you said, yes, indeed, electric vehicles, but also to other Asian countries, to Africa, also including those cars. It is a competition. It is a very strong threat for the European exports machine. Competitiveness is a matter of really domestic policies, but it's one of these last calls for Europe to realize that without strong economy and competitive economy, your economic might decreases, but also your geopolitical importance decreases.
And speaking of geopolitical influence, how should Europe navigate the tensions between the U.S. and China when it comes to trade? Because we have seen increasingly that Europe is losing its geopolitical weight and is increasingly more of a bystander when it comes to great power politics. So what advantages could Europe gain from the U.S.-China trade spat?
Well, so Europe has started to do that. So we've seen already negotiations with Mercosur, negotiations with countries in Asia, Asian countries. But the difference is that Europe is still a block of countries. It's not one country. And achieving this, signing these deals by any country is insanely complicated to sign a trade deal, especially one that is the actual final trade deal. And also when you then do it with countries which have different interests, maybe are concerned by competition, say from agricultural products from Mercosur countries, it is a little bit more difficult. However, what we've seen also is that policy predictability in Europe is quite strong. We've had a lot of rapid shifts in the US, while in Europe you have a little bit more of that predictability. So I think Europe can navigate that landscape through the more steady hand within its policymaking.
Now, moving ahead to the topic of AI, we see that the global AI revolution is in full swing, and the two biggest economies in the world, the U.S. and China, who one could argue have also become the leaders in AI, have pursued different approaches when it comes to the technology. So what are those different approaches, and how are China and the U.S. approaching AI in different means?
That's a fascinating topic, because when we look at U.S. first, a lot of U.S. growth, a large share of U.S. growth this year has been driven by AI buildup. It's huge. It's comparable, let's say, to the buildup in fiber optics, to the internet buildup. The only really bigger investment so far in the U.S. history was the construction of the railways, right, which was a hugely transformative technology. And so far, the U.S. has focused a lot on the hardware or the infrastructure for AI, so especially data centers, and then building yet another better model. Now, when we look at China, which is also in that race, the approach is slightly different. There is a little bit more of actual implementation of AI in especially manufacturing processes. So when we think about the subject you raised just before, which is that industrial competition, the different industrial policies and competitiveness of the Chinese manufacturing, a direct deployment of AI in manufacturing can boost that competitiveness even further. Right? So the question remains, which model will prevail, whether there's too much buildup, maybe there's been too much investment that then fueled the stock market. And you can sense that there's a sense of unease already within the investor community, whether that has not gone too far and whether we're gonna see a correction. And given the importance of these stocks in the US stock market, that correction can be quite disturbing to the overall decent mood in the markets.
Now, have other regions of the world, in particular maybe here in Central Europe, also benefited from AI in terms of productivity gains and other factors?
So there is different level of readiness to adopt AI, but emerging markets, and I would say lower income countries, can gain in particular from AI. You already have smartphones that have allowed these countries to leapfrog the technology gap, right? Mobile payments, information is flowing. Now imagine the possibilities offered by AI to students and people in developing countries. They don't have to have this physically. They can access all this knowledge of the world through AI. And that can lead to improvement productivity, management of companies, and so on. However, when it comes to the more advanced uses, there is the difference in readiness. But let's be honest, whether AI has really led to big productivity gains so far outside, let's say, of China, in the more Western-style economies. We're still not sure. We know it's there. We know it can happen. We know it happened with internet and the widespread use of computers, but it took time. But now, whilst we look at it from the perspective of time, we know that without computer, without internet, without cloud computing, we will not be where we are now. The question is exactly how we're going to get there with AI as well.
I see. And when it comes to the risks associated with AI, a lot of people have kind of talked about the potential downsides, including replacing human workers AI leading to mass unemployment from workers that lost their jobs. Are some of these fears overblown, or are we actually seeing this in parts of the world?
Like with many of these structural changes, it's very difficult sometimes to see them and assess them in real time as they happen. But we know already from the data that unemployment or hiring of the youngest workers, especially the so-called white-collar workers, actually has already decreased in the US, right? So this may be one of those signals that indeed these people are being replaced by AI. It may be maybe it's just a pendulum swing, maybe it's swinging a little bit too far, and later on companies will realize that they actually do need these people to be hired. But yes, a lot of the business processes, this kind of basic business processes, could be replaced by AI. And that has to lead to some difficult questions. Can these people be employed somewhere else if the buildup in manufacturing capabilities is not fast enough? Europe is already quite industrialized compared with the US, so we have a slightly different situation. But is that time gap, is the skills gap? Can countries actually replace that? And what it's gonna mean for social cohesion and the social contract in various countries? I think it's a fascinating topic, but we're in the middle of it. And it can go really in both ways depending on how we manage it.
Yes, and I was actually reading an article about that. I believe it was on the Wall Street Journal, how unemployment among white-collar workers has actually increased from about 2.5% to 3% in the U.S. in the past few months alone. So that's definitely, there's a lot of truth to what you just referred. So I want to move over to the currency markets. We saw that in the first half of this year, the dollar went through a big depreciation, a big decline relative to the euro. And that's in many ways despite the tariffs that were introduced, which, were supposed to reduce the U.S. imports and strengthen the currency. So where do you expect the international foreign exchange market to be headed in 2026 moving forward?
Indeed, what happened in the U.S., tariffs, uncertainty, questions about the independence of the Federal Reserve, and also plans or maybe certain ambitions to reduce the role of the dollar as the global international currency led to that depreciation. Probably the most of this weakness has already happened. So the US dollar exchange rate has shifted towards this maybe new level of equilibrium. But there is no strong catalyst for a strong appreciation of the dollar. The Federal Reserve is still cutting rates. And with the latest inflation prints that just came yesterday, with inflation headline and core being relatively low, and still uncertainty over the strength of the US economy, Federal Reserve will likely be cutting interest rates. On the other hand, the major other central banks, so the Bank of Japan, European Central Bank, are less keen on further cuts. Actually, they want to cut, they want to hike like in Japan, and in Europe there may be some more of cuts. So that means that the rate differential will not be favoring the dollar, which means that it's quite positive for the other currencies. However, I think the most of the weakness of the dollar is done, but I don't expect the return of the so-called king dollar we saw in 2022 when dollar really appreciated against all the possible currencies.
And at the same time, we've seen a massive rally in precious metals, particularly gold and silver. Silver especially is up over 100% year to date. So do you think the same factors that caused the dollar to decline are playing out in the precious metals market and causing gold and silver to rise?
I think there's a little bit of a difference there. So one thing is that dollar prices started to go up when we still had a period of high inflation and still high US interest rates when dollar was strong. Gold is quite often used as that hedge against inflation because it's still a physical asset. But also what we see is that we have a combination of factors. US does not want the dollar to be still that dominant global currency, or maybe it's just a stated policy goal. Central banks, asset managers want to diversify away from the dollar. You can buy European bonds, you can buy any other DM bonds, but in the end, the dollar provides that necessary hedge. There is also a lesson from sanctions and the freeze of reserves that Russia has experienced. Other central banks may be concerned about that. There is also geopolitical risk. In the end, having this hard metal as insurance can help some central banks, and a few central banks, including here in Poland, have purchased more gold. But there is no central bank gold rush as such. And let's not forget, people, individuals, are buying gold as well. One, to store value, but also as a global economy and especially emerging markets get richer, people just buy more gold. So dollar has surged and probably will continue to grow. And then silver also becomes an alternative asset that then follows, because dollar prices are already so high that some of the investors may be concerned that they are already too high. So silver provides this alternative. Of course, within the metals, there's also a little bit more of just the industrial cycle, but that's much more complex and much more widespread across various metals.
So wrapping together the factors that we talked about, whether it's AI, whether it's trade, where do you see the global economy headed in 2026? Is growth likely to accelerate, decelerate? What's your opinion on that?
It's probably steady because what we see on the one hand, U.S. economy is doing better than expected and will likely benefit from a number of factors. Fiscal policy still relatively loose in the U.S. Interest rates likely going down. Labor market is holding up, but it's very bifurcated, and the AI buildup will continue. On the other hand, China will struggle to maintain the stated goal for growth, right? So whether it's going to be 5% or maybe 4.5%, but policy is definitely geared towards generating growth. Europe is doing okay. I think Europe has a chance to grow at a decent pace, but below that. Here, this region, growth will likely stay relatively strong, also because of quiet, strong labor markets. Fiscal policy is relatively loose in the region, maybe except, let's say, Hungary or Romania. So that all points towards, and also the major other emerging markets, so let's say Brazil and others, are doing okay. Central banks cut rates. So global growth will likely stay around 3%, which is the definition of the global neutral. Which is a good point. It's neither too hot, it's not too cold. It's not inflationary, it's not deflationary. So actually it's a good spot to be. And for the markets, it will remove one of the sources of uncertainty. And there's plenty of them. So not worrying about global growth should be positive for markets.
So to wrap up, looking at Central Europe specifically, where do you see the Polish economy headed in 2026? Because we see that this year growth here has been accelerating. The latest GDP print was nearly 4% year over year. So where do you see the Polish economy headed next year?
It should be another good year, barring any very unexpected negative events. Obviously, as economists and markets, we can never exclude that, but it should be a good year. Why? Fiscal policy remains relatively relaxed, both because of defense spending, but also because of the other social spending. Labor markets are very strong. Unemployment remains at record low, so definitely that's going to fuel consumption. Wages are growing at a decent clip. It's not as high as it used to, but the real wage growth is relatively all right. Energy prices have stabilized. That's also good. And of course, there is the continued inflow of EU funds, being just a structural fund, RRF funds, and also starting from next year and later also the defense funds, which can also support infrastructure. So overall, it's a good mix. The only worry I would have is that parts of the Polish economy may suffer from a competition from other countries, especially exports from either China or some other emerging markets, which may compete with the Polish producers, because they are and do remain cheaper than the Polish ones. So otherwise, I think a good year, but as an economist, as an investor, I always think a little bit in the back of my head about some of the tail risks.
Magdalena Polan, thank you so much for your insights.
Thank you so much. Thanks.
That's all for today's edition of News in Depth. Be sure to stay tuned for more on TVP World.